So if you've been tuned into financial news over the past year, you've probably noticed that the world is suddenly overrun with SPACs, a financial trend that unites the likes of Richard Branson, Alex Rodriguez, and Stephen Curry, all in the name of making you money. But you might have wondered, is this all too good to be true? SPAC stands for Special Purpose Acquisition Company, and it's commonly referred to as a blank check company because, functionally, it's a means by which some investors write a blank check to some other investors. Here, a bunch of institutional investors, and perhaps one of their celebrity friends, sell shares in a company that doesn't really exist yet. Instead, they invite outside investors to give them money, which then goes into a big pile of cash, and then somewhere down the road, the SPAC merges with a private company yet to be determined, yet to be named. Once that transaction takes place, everybody who bought into the SPAC will become a shareholder of the newly combined, formerly private, now public company. And in the meantime, they can ask for their money back if they don't like the deal or if they just get tired of waiting. So SPACs aren't whatsoever new, but their popularity very much is. After a long period of unpopularity, there were nearly 250 SPAC IPOs in 2020, and there were nearly 300 in the first quarter of 2021 alone. To outside investors, the allure is pretty simple. Picking stocks is difficult, and blue chip investment firms, arguably, are going to be better at it than the average person. SPACs also promise to resolve what can be an annoying thing about IPOs for investors outside the cadre of institutionals who participate in these deals. Let's make one up. So Company X goes public at $19 a share, so that's how much the bankers pay for it. But then, minutes after it starts trading on the NASDAQ or whatever, it's $36 a share. Now that's great for those bankers, but if you're Joe Schmo investor looking on from the outside, you can only buy in at $36. Now the SPAC, at least theoretically, allows you to buy in before that bump ever takes place, which is when the merger happens. And so at least ostensibly, you get to participate the way the bankers usually do without actually being a banker. Now to the institutional investors who sponsor these SPACs, the benefits are far less theoretical. In most SPAC agreements, the people who start them put in only a nominal amount of money to get the ball rolling, and in exchange they get a 20% stake in the resulting company. But probably the biggest beneficiaries are the target companies themselves. The traditional IPO process is time-consuming, expensive, and dilutive, meaning that companies often have to give up about 30% of their stock in order to get a deal done. By contrast, merging with a SPAC minimizes the number of parties you have to negotiate with, shortens the time to which you can actually go public, and ostensibly leaves less money on the table in those post-IPO share price pops we talked about earlier. So if investors, companies, and A-Rod are happy about SPACs, what's the catch? The risk with SPACs relates to scarcity. Very few of those 500 plus SPACs we talked about have found and merged with private companies, and the vast majority of them, based on their bylaws, only have 2 years to do so. So considering the SPAC boom just started last year, in 2022, a lot of these SPACs are going to be staring down their expiration dates looking for merger targets. And that's when we could see a lot of these SPACs facing a game of musical chairs in which they might have to agree to questionable deals in order to avoid giving back all that cash they raised. That could lead to some disappointing returns for investors, which might make them look more skeptically at future SPACs down the road, regardless of whether Shaq is involved.